right, everyone. Thank you for joining today. We have a very special guest, Franklin Downing, co-worker here at ARK Invest. Sam won't be joining, but hopefully he'll be back next week. But we're going to get into Celsius and everything happening in the crypto market in just a minute. First, I'll read the disclosure from ARK. The information provided in today's session is for informational purposes only and does not constitute an offer, solicitation, or recommendation regarding any investment product or service. Any reference is not an endorsement by ARK nor a recommendation by ARK to buy, sell, or hold. We cannot discuss any private or non-public material information of any kind. Participants should determine for themselves whether a particular service or product is suitable for their investment needs or should seek professional advice for their particular situation. Certain statements on today's call may be statements of future expectations or other forward-looking statements based on ARK's current views and assumptions and involve both known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied. ARK does not assume any obligation to update forward-looking information, and all information discussed today is subject to change without notice. In addition, certain information obtained from sources that ARK believes to be reliable. However, ARK does not guarantee the accuracy or completeness of information obtained from any third party. Okay, let's get right into it. Frank, why don't you go ahead and just introduce yourself, and then we can start firing off the questions around Celsius.
Sounds good. Thanks, Nick, and happy to be on the show as a guest today rather than a co-host. So I'm Frank. I work with Nick on the Next Generation Internet team at ARK. I spend a majority of my time covering the crypto markets. I've been around the crypto space since 2017 when I started mining crypto at home and have been working at ARK, looking closely at this space over the past year and particularly hyper-focused on kind of the events over the past 2 months, in particular the kind of the unwind of Terra, which we talked about last time I was on the show, and now we have Celsius as well.
And we promise that in the future we'll bring you on to talk about some positive news in the crypto space. But it seems like, right now everything is quite bearish, especially given the events that have unfolded over the past week. So maybe we can just start. And you can give a very high-level overview of what has happened, give us a timeline all the way up until today and where we are now. Celsius and Ethereum and Bitcoin all being down here and bringing the market down. It would just be great if you can just list off exactly what's happened for our listeners today.
Yeah, sure. Happy to get everybody up to speed. So I think kind of following the Terra collapse in May last month, I think some would have called the market bottom there, but at least in our view, there were kind of more events or more information that had to come out to really see the true ramifications of that. And while the collapse there was pretty isolated, it brought down crypto prices pretty dramatically and kind of furthered a broader risk-off motion in the market. And one of the things people do when they get in a risk-off mode is withdraw their assets from places that are more risky and move into less risky positions. And one of those places where a lot of assets have been deployed is in crypto lending firms. So Celsius, BlockFi, Nexo, these are all some of the largest crypto lending firms in the business. They've really exploded over the past 2 years. Celsius in particular has excelled. They became the first crypto lending platform to cross 20 billion in assets under management in August of 2021. Likely grew quite a bit bigger than that as Bitcoin hit all-time highs in November. And as crypto prices have drawn down, their AUM was cut in half from that August milestone to 10 billion as they last reported in June. And generally, with the fear in the market, customers have been withdrawing assets from the platform. Now, what's interesting and important to note here is how these firms are generating the yield that they're giving to customers. So for reference, on Bitcoin and Ethereum, they've been giving rates around 3 to 4% annual interest. And on stable coins, it's been 8 to 10, sometimes even higher than that percent interest per year. And all of these firms do a mix of activities, but Celsius in particular has had kind of the highest rates, which have allowed it to get this kind of market leading position. And to actually generate that yield, Celsius participates in institutional lending, so lending to hedge funds or mining firms, doing their own mining. depositing assets into proof of stake networks where available and earning a native staking APY, or participating and leveraging assets in DeFi to generate additional yields. And to give an idea of what that might look like, one can deposit an asset like Ether or wrapped Bitcoin into a protocol, borrow stablecoins off that, and use those stablecoins to either lend out to other parties or generate further yield through what's known as yield farming. There's all kinds of crazy activities that can be done there. And I think what happened really kind of leading up to today is people became more and more aware of how Celsius was generating these yields in terms of exactly where their deployments were, and in particular, the size of their assets that were deployed into DeFi. And so if you look at how they've deployed Ether, for example, of their known Ether holdings, which we can track through their on-chain wallets, they deployed 30% of that Ether directly into Ethereum's proof of stake contract, which is illiquid at this time, meaning it can't be withdrawn until Ethereum completes its merge to proof of stake and withdrawals are enabled, which we don't think will happen until early next year. So that's 30% of Ether that's totally illiquid. Another 41% of supply was deposited into Lido's liquid staked Ether position, a product. And that product basically allows staked assets to earn a yield and be deployed at in DeFi at the same time, which is great for generating yield, but also results in an additional level of illiquidity. So in order to exit that staked Ether position, Celsius has to sell it on the open market because withdrawals aren't enabled until early next year. And so what people started noticing is, only 29% of Celsius's Ether position is actually liquid and able to fund withdrawals. Beyond that, they have to sell staked ETH at a discount to the market. Right now, that discount's about 6%, but it grew from 2% kind of earlier this month. And so as the market can see that Celsius has a relatively illiquid balance sheet, it increases fear, which increases the rate of withdrawals, which decreases Celsius's liquid position, and you kind of have this vicious cycle that led up to Celsius pausing withdrawals on the platform late Sunday night. And as the markets woke up and realized that this has happened, really signaling potential insolvency of one of the largest crypto lenders, that's what brought kind of markets further crashing down over the past 2 days.
Okay, so a lot to unpack there. And, what we're seeing now is kind of one, that Celsius has halted withdrawals, and I'll let you get into that in a bit in terms of what that means for Celsius users and potentially the broader market. And then I'm curious, as this continues to unfold, because it doesn't seem that it's over, or maybe it is, and that's, another question for you, but what does this look like now going forward over the next few weeks? What does this mean for the broader crypto community? How do you stave off further liquidations on Celsius and some of these other platforms that are operating in a similar way?
Yeah, so you're kind of bringing up a good point that although I went deep on that intro, I did leave off one key point, which is that important to note that Celsius has not just deposited Ether into this liquid staked Ether product. It's not just wrapped Bitcoin and put it on Ethereum. It's borrowed against those assets. So if you add up the value of the known assets that Celsius has deployed across Aave, Maker, and Compound, which are the three largest Ethereum-based lending markets, they've deposited $1.5 billion of collateral across Ether, wrapped Bitcoin, and staked Ether. And they've drawn $750 million in stablecoin denominated debt off of that collateral. And so in order to take those, remove those coins from the DeFi protocols, they need to pay down that debt. And so Celsius is currently in the process of raising funds to slowly pay down debt. That could be calling back funds from institutions that they've lent money to. It could be pulling from bank accounts or liquidating other assets, whatever they need to do to pay down that debt. The fear for what happens next is if crypto prices continue to fall, those positions are at risk of liquidation. if prices fall below a certain collateralization limit. And so we can actually monitor this in real time on chain. Celsius's maker position, for example, would get liquidated at around a 15,000K Bitcoin level. And that actually has come down over the past few days as Celsius has been adding wrapped Bitcoin as collateral and paying down debt to some extent. Previously, it was around 20K, which obviously Bitcoin has gotten very close to. And so the fear is, or really what we're watching is, how will they, now that they've paused withdrawals to give themselves a little bit of buffer room, start to pay down this debt and unwind these positions, eventually to a point where they feel good enough to open back withdrawals to their customers? And if they can't do that and their positions are liquidated, what that effectively means is a loss of funds that would lead them to be or appear to be insolvent. If that were to happen, I mean, we've already seen a dramatic blow to market sentiment. That would get worse. And I think ultimately we're going to see an accelerated pace of regulators moving into this corner of the market and probably crypto at large. If you look at the crypto lending space, in the past few months, regulators have already been really hot on it. In particular, a good example is BlockFi having a $100 million settlement with the SEC and being unable to issue their product in the U.S. Until they reintroduce it as a security. And Celsius has largely looked like they're going to be in the same position. They blocked product to non-accredited investors in the U.S., but they still allowed those who had been in the platform before this rule got put in place to keep their money in, which is why they have such a large position to begin with.
So I want to just maybe hone in here on the one interesting piece of all of this, in my opinion, is that no matter how you spin it, no matter how much capital Celsius is able to acquire here to stave off some of this liquidation, there's still 30% of their assets locked in an illiquid proof of stake protocol, which means, as soon as they open back up their withdrawals, unless you have nerves of steel, what is the reasoning to stay with Celsius? Have they lost consumer confidence here? And if that's the case, as those withdrawals continue to pile on, there's 30% that they have no way of getting access to. Or am I understanding this differently? How does this not end with, Celsius ending up in bankruptcy or no longer existing? How do they work their way out of this type of situation? It seems like they're in some pretty big trouble, and we're, in a moment in time where it's been somewhat paused because they've had this ability to just lock out everyone. They essentially just shut the doors on the run on the bank type of situation. So how do they get themselves out of this, given that 30% of their assets are locked in something they have no ability to get those assets out of until, ETH merges to proof of stake?
Yeah, great question. And to give a sense for scale, that 30% of their Ether position that's locked directly into the ETH2 staking contract comes to about $400 million worth. So if you look at their total assets that they're managing, they last reported they were about $10 billion on June 2nd. Crypto markets have come in 25 to 30% since then. So you can expect they're probably around $7 to $6 billion in assets. So it's a significant number. It's not all of their assets. But what I expect what would happen is that in the case that they have withdrawals to the point where they need to access that staked ETH, they would need to do an over-the-counter deal of some kind to trade that ETH to a party that's willing to take on kind of this long-term view and be willing to hold that ETH until the merge happens. Now, obviously, they can't, because it's locked in the contract, they can't actually withdraw the coins. So they would have to do some sort of over-the-counter deal, give access to the private keys, or have some sort of off-chain contract that stipulates the terms of that agreement. So it would be messy. I expect for sure it would happen at a discount to the market value of ETH. And so you could expect they'll take losses there. Celsius also says, like, important to note that they have $700 million of insurance or an insurance fund of some kind, which would be enough to cover this. It's a situation where we have quite a bit of transparency, but not 100% of transparency because not everything is happening on chain. But to Celsius's credit, to some extent, they do publish their weekly flows data in terms of the assets that are flowing into or out of the protocol every Friday, with the exception of 1 week in mid-May. And from that, you can see the number of Bitcoin withdrawn, the number of Ether withdrawn, and the total flows in a dollar value. And so if you add up from late April to date of what was published as of last Friday, they outflowed $1.5 billion of assets total. And so they have been somewhat transparent there. We do have the on-chain data, so we can watch these liquidation thresholds in real time. But we don't know exactly what are the assets that are not held on-chain in these Ethereum wallets. How long will it take to call back those loans to meet withdrawals, and what kind of deals will they have to make to liquidate or receive ample funds to feed withdrawals for these more illiquid positions.
Yeah, that's interesting that you brought up the insurance contract that they have out there. Not trying to spark any fear or spread rumors here, but I would be very curious to understand who underwrote that deal, what insurance carrier they use. I'd have to imagine it's probably, someone new to the insurance space. I can't imagine a traditional insurance underwriter doing such a deal like this. And it would be interesting if that company would even be solvent enough to, issue $700 to $800 million in protection coverage. But curious, what this means, I guess, for the overall DeFi space. Is this going to cause, I have to imagine a lot of investors in Celsius and customers of Celsius are going to be left with a pretty awful taste in their mouth, seeking yield, using DeFi. It was, not too long ago, we were talking about DeFi summer and everything that was exciting and new happening in the space. And slowly we're seeing a lot of this coming and crashing down back to earth. So what are you expecting to see in the DeFi space over the next few years? How do we move past this? What is the long-term outlook now that we've had a few of these seemingly great protocols and companies blow up in everyone's faces?
Yeah, great point. I think I have two things I would comment on it. Number one is we only have the visibility that we do into exactly Celsius' position because of the transparency of DeFi. So we can see what their liquidation price is. We can see how much they've borrowed and how much collateral they have. And we can watch if they're at risk of getting liquidated tomorrow or if they're safely paying down their debt. And in that lens, I think DeFi is kind of working as designed and actually making this transparent more than it would be without DeFi. The other thing I'd say is that to a point, money has flown out of DeFi protocols, but DeFi protocols have not failed at large. If you look at Maker, Aave, or the exchanges like Curve and Uniswap, those are actually largely acting as designed and obeying the rules of the protocol. And it's within the rules of the protocol that if you over leverage yourself and can't unwind your position, you get liquidated. And so that's a risk that Celsius took, and bad on them for not making it as clear to their depositors. But the DeFi protocols in the back end seem to be acting as designed. Now, that's not to say that a systemic risk or flaw couldn't show itself, but right now we haven't seen that. On the negative side, I think one thing that was kind of misunderstood is how much of the value that was being managed in these decentralized protocols was actually a factor of centralized lenders moving in. So how much of Celsius's assets were really a majority of the TVL in DeFi, I think is now more being understood. If you look at the total value locked in DeFi, which is a good proxy for kind of the total activity in the space, it went from $160 billion on April 1st to now $63 billion today. And that's a factor of a few things. Number one is asset price decline. Number two is the blowup of Terra. If you look at Anchor, that was a $20 billion platform that virtually disappeared overnight, though it was an isolated incident that really just affected that protocol outside of the price depreciation it caused. But we're seeing really, as these centralized parties have to pay back their debts and move into risk off positions and face liquidations, money is kind of flowing out of the DeFi space. That being said, I think our long-term thesis for decentralized finance is still very much intact, and if anything, strengthened by this. It shows how a centralized party can take excess risk that is not fully transparent or communicated transparently to its users, and how in the future, financial services that are built more natively on chain have the chance to operate in a disintermediated, lower counterparty risk measure than going through a central intermediary. And I think everybody who has funds in Celsius now that can't withdraw them sees the value in that.
Got it. I'm going to ask you to speak for the DeFi community at large and ask you, is regulation wanted or needed in this space to move forward? Or is that entirely against the ethos of DeFi and what crypto stands for? Is some regulation needed to protect consumers from this type of blow up?
There are mixed answers in the community. If you look at Robert Leshner, who's the founder of Compound Finance, they've kind of pivoted from managing the base protocol as they've launched a governance token, decentralized management of the protocol, to really focusing on how can we bring institutions into DeFi in a safe way. And they would say, along with Uniswap, which is in a similar position, more regulation really opens the doors for institution more than harms the potential growth of the industry. Because as much as we talk about this new financial system, for the traditional players to get on board, they can't touch a platform that is unregulated or that is actively under investigation by regulators. And so I think to the extent that the rules of the road are laid out in terms of exactly, at least from the US context, of who can act in DeFi and how can they act in DeFi in a compliant way, that will be better for the ecosystem as a whole. The second thing I'd say is that these protocols are global by default. And so one jurisdiction's regulations don't affect the growth of the entire system or the extent at which it can scale. The US is obviously a large market, but you can see from China banning cryptocurrencies, that hasn't overtly harmed the protocols. And so one nation may ban themselves or restrict themselves, but another nation may use it as a strategic advantage to fully embrace these protocols.
And then in terms of working down the stack here, we've had this conversation internally, but I think it's important to what we've just now witnessed, over the last few weeks is this battle between centralized players and decentralized players. And I think you hinted a bit about, how some of these decentralized protocols are operating quite well under this, enormous stress test that the broader crypto market is going through. Whereas you have some central players that have taken on too much leverage or operated in some sort of bad way that's hurt them, whether it's the Terra Luna debacle or now what we're witnessing with Celsius. So where do you stand on how much centralization is needed to bring crypto to the masses versus what everyone initially I think hoped for with crypto, which was a new decentralized standard that people ultimately end up using? Or is centralization needed to bring this to the mass market?
Yeah, great question. And I'd recommend anybody to check out our Big Ideas report for 2022, where I think we dimension this really well. But fundamentally, I think there's a spectrum of decentralization and the appropriate level of decentralization for different use cases. We look at the revolutions kind of inspired by public blockchains as three different revolutions. The monetary revolution, which is self-sovereign money that is outside the realm of nation states and government influence. There's this decentralized finance space, this financial revolution, decentralized protocols replacing traditional financial intermediaries. And then there's the Web3 NFT gaming space, kind of the new next generation of the internet that's seeking to supersede the consumer internet of today. And I think when you look across those three revolutions from left to right, the 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 level of decentralization you need to succeed as a self-sovereign money or an independent decentralized finance protocol is much higher than what you need to succeed to secure a gaming use case, for example. And so I think that's why you see protocols like DeFi, Bitcoin, for example, focused singularly on this monetary revolution and not sacrificing decentralization at any cost. Bitcoin is not trying to add features or satisfy future technological demands. They're remaining extremely conservative to maximize decentralization. When you look at Ethereum's position is kind of in the middle. They support more functionality than Bitcoin. You could argue lower relative security, but definitely the highest decentralization rate across smart contract blockchains. And I think that puts Ethereum in this real sweet spot of offering the right level of decentralization for the decentralized finance ecosystem built on top of it, and to an extent, Web3 and NFTs. There's other blockchains like Solana or Avalanche that make considerable sacrifices in decentralization to reach kind of higher throughputs. But to get back to your question, outside of kind of that very base layer of how do these technologies scale, I think it's reasonable to expect, especially in kind of the Web3 more social space, the need for ease of use and kind of functionality to take over a bit from ultimate decentralization. And so how I kind of think of it is that, well, we need a decentralized data layer and ownership layer on the back end. There will likely be centralized players that come in and help technology scale kind of on the front end. For example, if you think of a AAA game that's trying to be a Web3 game, that front end, that gaming interface, it's virtually possible to make that decentralized. There's going to be a central team that's building this AAA game, that's updating it, that's running these servers in reality that power the game engine. That being said, that game can tie into a decentralized backend that is a public blockchain like Ethereum. And I think that's kind of the balance we'll see kind of in that more Web3 gaming space.
Got it. And that's a great answer and potential question to end on. I do want to just, given how transparent the crypto markets are, give our listeners a chance to look at what you're watching and how you're monitoring the situation. So, what are some of the sites, tools, and services that you're using to monitor this real-time situation that maybe some of these listeners would want to watch as well?
Yeah, there's a few good resources out there. I think for monitoring DeFi positions, there's a few applications that I use regularly. DBank, Zapper, and Zerion are all three that seek to offer kind of a comprehensive portfolio view where you can plug in a crypto address and see all of its positions on DeFi. If you look up Larry Cermak, he's the head of research at The Block, which is a great crypto news publication. He published yesterday a list of all of Celsius's known wallets. And so you can take those wallets and plug them into any of these tools and see not just their positions, but their transaction history kind of in real time. And so you can actually watch as Celsius is paying down its debt, its collateralization level is going up. So that's the main one I've been looking at for this. The other, just to give a comprehensive view of where kind of value is stored across the DeFi landscape, is DeFi Llama, LLAMA, like the animal. That's another good one.
All right, great. Thank you, Frank, for joining. Thank you all for listening today. As always, we'll wrap up with our disclosure. Feel free to stay on. If not, thank you again for joining and have a great rest of your day. The information provided in today's session is for informational purposes only and does not constitute an offer, solicitation, or recommendation regarding any investment product or service. Any reference is not an endorsement by ARC nor a recommendation by ARC to buy, sell, or hold. We cannot discuss any private or non-public material information of any kind. Participants should determine for themselves whether a particular service or product is suitable for their investment needs or should seek professional advice for their particular situation. Certain statements on today's call may be statements of future expectations or other forward-looking statements based on ARC's current views and assumptions and involve both known and unknown risks and uncertainties that could cause actual results, performance, events to differ materially from those expressed or implied. ARC does not assume any obligation to update forward-looking information, and all information discussed today is subject to change without notice. In addition, certain information was obtained from sources that ARC believes to be reliable. However, ARC does not guarantee the accuracy or completeness of information obtained from any third party. Thank you all for joining. We'll hopefully be back on next week around the same time, 4:30 on Tuesdays. And Frank, thank you again for joining.
Thanks, Dick. Take care, everybody.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.